All right, let's talk ROST Stores. Their latest earnings call for Q2 2025 just dropped, and it's a really interesting one. You've got this story of solid performance on one hand, but on the other, some pretty serious headwinds they're fighting against. We're going to break it all down.
So here's how we're going to tackle this. First, the headline results, the big numbers. Then we'll dive into the tariff situation, which was a huge deal. After that, we'll look at their game plan for growth, what they're saying about the future, and finally, we'll give you our take with our next call rating.
Okay, let's jump right into section 1, the headline results. This is the stuff that hits the tape first, giving us that initial snapshot of how they did.
And right out of the gate, we've got a beat. $1.56 for earnings per share. Now, you got to know that's better than what the analysts on Wall Street were expecting. So, yeah, that definitely turned some heads.
So here's where the story gets a little more nuanced. It was kind of a mixed bag, right? They beat on earnings per share. That's the profit. But you see, they just barely missed on revenue. What does that tell you? It means they are masters at managing their costs, but getting those sales numbers to pop was a bit of a struggle.
Okay, this chart really lays it all out. You see comparable sales, that's sales from existing stores, up 2%. Not bad. Total sales up 5%, which is great. That's driven by new stores. But then you look at the operating margin. Oof, down almost a full percentage point. That's a big squeeze on their profitability. So the immediate question is, why?
And that question leads us directly to the main villain of this story, if you will, the tariff headwinds. Seriously, this was the topic of the call and the biggest reason for that margin hit we just talked about.
So, if you had to pinpoint the single biggest challenge for ROST this quarter, what was it? Well, management left, no doubt.
11 cents. Just let that sink in. Tariffs alone knocked a full 11 cents off their earnings for every single share. That's huge. I mean, think about it. That accounts for almost all of that margin drop we saw earlier. It just goes to show you how much of a punch this external factor packed.
So of course, the next question is, what are you going to do about it? And ROST came prepared with a four-pronged attack plan. First, they went straight to their suppliers and said, hey, we need to work together on this. They also started looking for new places to get their products, diversifying their sourcing. And, classic ROST, they doubled down on what they do best, hunting for amazing closeout deals. And finally, they were super careful about not just jacking up prices for you, the customer.
And this quote from the CEO really gets to the heart of their philosophy. Every part of their strategy, every single move was about protecting that core promise. They know that people come to ROST for a deal, and they absolutely cannot afford to lose that edge.
Okay, so we've talked a lot about defense, fighting off those tariffs. But don't think for a second they aren't playing offense too. Let's get into their growth playbook, because they are definitely looking to score some points and expand their territory.
And man, they are busy. Look at this list. We're talking about 90 new stores this year alone. That's aggressive. And they're not just building where they already are. They're successfully breaking into new areas like Puerto Rico and the New York Metro. But what I really like is that they're also sprucing up their existing stores. Half the chain is getting a refresh. That's a big deal for the shopping experience. And hey, self-checkout. They're testing it in about 80 of their busiest stores to get you out the door faster. It all adds up to a company that's investing heavily in its own future.
All right, so with all that going on, you'd think they'd be super bullish, right? Well, not so fast. When it came to talking about the future, the guidance, the tone got a lot more cautious. Let's dig into why.
So here are the numbers they put out for the rest of the year. They're still expecting decent comparable sales growth in that 2 to 3% range. But look, that pesky tariff impact is still hanging around. It gets a little smaller each quarter, but it's not gone. And that is the main reason why their overall profit forecast for the full year is what it is. Management also brought up a key piece of retail jargon, pack-away merchandise. What is that? It's basically their secret stash. They find amazing deals on stuff way ahead of time, buy it for pennies on the dollar, and pack it away to sell later. It's usually a huge advantage. But just because of some weird timing with costs, it's actually going to hurt their margins a bit in Q3. They said it'll flip back to being a positive in Q4, but it's something to watch for next quarter.
All right, that brings us to the final section. Let's put it all together. We've heard the good, the bad, the headwinds, the growth plans. So what's our call? Let's synthesize all this into our rating.
So our prediction for the next earnings call is this. We think they'll hit their numbers, pretty much right in line with their guidance. Why? Because their core value proposition, getting great stuff for cheap, is exactly what shoppers want right now.
But that's going to be fighting against those margin issues and the fact that everyone's a little nervous about the economy.
And what does that mean for the stock price? Well, we think it's probably going to trade sideways for a bit. It's what we call range-bound. The market already knows the good stuff and the bad stuff. For the stock to really move, we'll need to see some big news from outside the company. You know, a big change in consumer spending or, you guessed it, more news on tariffs.
So when we boil it all down, our final rating for ROST stores is market perform.
And let me quickly break down the thinking there. First, everybody knows ROST is a solid company. That's already baked into the stock price. Second, with those margin pressures and the cautious outlook, it's hard to see a catalyst that's going to make the stock shoot way up in the short term. And finally, all those great growth plans we talked about, they're awesome, but they're long-term plays. It's going to take time for them to really boost the bottom line. So solid company, but we expect it to perform pretty much in line with the rest of the market.
And of course, we have to end with our usual reminder. This is not financial advice.